Good afternoon. We are Group 10. We are Álvaro, Daniele, Samuel, and Pedro, and we are going to do our presentation about beverage companies analysis. For this study, we have chosen the companies Heineken, Mau, Compañía Norteña Norvega, which is a subsidiary of Coca-Cola, and DAM. These companies, as we said before, form part of the industry of the manufacture of beverages, and we have based on our analysis on specific ratios. Some of them are quite redundant and don't give any additional information to others.
We will start with the patrimonial analysis. Working capital. The working capital allows us to measure the financial health and short-term liquidity of a company. Mau, DAM, and Norvega, all three of them have a positive working capital, which is generally indicative of financial stability. On the other hand, Heineken possesses a negative working capital, which may indicate difficulties in meeting short-term obligations, as we can see in the graphs and the data table. The current ratio. It allows us to measure a company's ability to cover immediate liabilities with its short-term assets. Both Mau and DAM have ratios greater than 1, suggesting it can comfortably cover its short-term debts. For Norvega, it's the same scenario, although a value close to 3 may suggest that the company is not efficiently utilizing its current assets. In the case of Heineken, a current ratio lower than 1 can raise several concerns about the company's ability to meet short-term obligations. The acid test is used to evaluate a company's ability to meet its short-term obligation with its most liquid assets by excluding inventory. Mau, DAM, and Norvega have values greater than 0.8, which is considered the minimum a company should have. This suggests a healthy level of liquidity as they exceeded by a wide margin. For Heineken, this ratio does not even reach 0.5. This indicates that the company may struggle to meet its short-term obligations using its most liquid assets.
The financial autonomy ratio shows the degree of the dependence the company has on creditors. As we can see in the graph, Heineken and DAM show optimal quantities that are quite stable. Then Mau has a higher quantity, but is quite reasonable as well. And Norvega shows a super high quantity that doesn't show any stable financing. The total solvency shows how the company is able to cover the liabilities. Heineken and DAM have correct values and quite at the optimal numbers. Mau is quite high, meaning it's a little too solvent, and they could do their financing a bit more efficiently. And Norvega, as they didn't have many liabilities, they have excess solvency. And the coverage ratio is linked to liquidity in the long term. Nearly all companies have quite good terms of liquidity. Only Heineken is a bit low, but still they are over 1, so they can afford the liquidity.
Then we have the debt to equity ratio, which measures the amount of payment commitments made with regard to own resources. And as we can see in the graph, all companies are very in the same values, except for one. DAM remains close to the optimal value, and Heineken is the exception, which is far above the optimal, which is 1. Mau and Norvega are below the optimal value. They are safe, but they may not be taking advantage of debt financing and tax advantages. Then we have ICR, interest coverage ratio, that measures how well a company can pay the interest on its debts. Mau and especially Norvega have recent high values, This means that they don't pay much interest and have a great ABT. Dan has, as the two previous firms, doesn't have problems. And of note, it's Heineken 2020 year, which had a negative EBIT, but no more troubles. Level of capitalization ratio is the indicator that measures the relative importance of self-financing in the equity of a firm. Mau, DAM, and Norvega have been having values very close to 1 for the last 4 years. That means that these three firms' equity is mainly composed by its reserves. Heineken is the exception, and that means that Heineken's equity is composed by shareholder fund. And as seen as previously, Heineken had a negative EBIT in the 2020 year, and this could have caused the negative value reserves that we can see in the graph.
The last ratio of the patrimonial analysis is the capitalization growth ratio. And in this case, present how much reserves increased from the previous year to the analyzed year. Everyone is almost stable except of Norvega in 2020. The only exception is Heineken, who from the 2020 started a very much significant decrease in accumulation of its reserve. There isn't a very clear quantity of reserve that a company should accumulate, but for sure a negative accumulation is always a bad thing. Now let's dwell in the economic analysis ratio. The first one is the economic profitability, ROI or ROA, and is calculated by dividing EBIT by the total asset. Everyone in 2020, due to the COVID pandemic, decreased the economic profitability, but also in this case, the company that decreased the most was Heineken. But the good thing is that after 2020, every company started to re-increase their level of economic profitability. Financial profitability is has a very similar trend to economic profitability, because we see almost the same colors in the tables. I remember that the high values are in green, the not so high in yellow, and the negative red. And if we see the two tables of ROI and ROE are very similar, also in this case, and again, as a negative financial profitability in 2020. Another important ratio is the financial profitability after taxes. And again, we see the same trend. Obviously, here, being after taxes, the financial profitability is a little bit lower. In fact, the green values are green after not the 10%, but a 5% increase. And even in this case, and again, is negative. The last ratio of economic analysis is the financial leverage, which is very important because it helps us understand how much debt are utilizing the different companies. The higher the financial leverage, the higher the amount of external debt that a company utilized. We have an outstanding value in 2021 of them because they used a very, very high quantity of external debt. But we see that every company in the table utilized many more quantities of external debt than internal equity.
Following with margins. The first one is operating margin. This measures the proportion of the company's revenue that is left after paying the operating costs of production. It indicates really how much the company manages to keep the company going. In the table, we see two colors. These are comparisons with the general average. So we can see that Mau is always over the general average. But for example, Norvega is always under this value. So this means that Norvega operates with a lower efficiency than the other companies. The ordinary margin is quite similar to the operating margin. is the profitability of the company before interest and taxes. With the same example as before, it's the comparison between all the general averages, and Mahou and Heineken are always or nearly always over the margin, and Noruega is always below, meaning it's less performance. And the last margin is net margin, and is the proportion of revenue that remains as profit after everything being paid. As we can see, Mahou and Damm are always over the general average ratio, and Noruega is kept as the lowest one. So Mahou and Damm and Heineken are always managing more efficiently their revenues. During this project, we also calculated these ratios, but we are not going to talk about them because they are quite redundant.
So to end with our job, we have reached some conclusions. The first one about Mahou, that during these 4 years they have had no problems with debts, and we think they are in a good financial health. Maybe they are a bit cautious and should take more advantage of debts as an opportunity for further growth in the firm, as seen in the debt to equity ratio previously. On the other hand, the ROE and ROI values have been decreasing, and that could mean that they are losing the ability to be as profitable as they used to be.
For Damm, based on the previous analysis, it exhibits moderate financial health with stable solvency and reasonable liquidity. However, the company has experienced a decline in profitability, as evidenced by decreasing net margins and ROE. Despite this, Damm's moderate debt levels and adequate interest coverage ratio indicate a balanced approach to leveraging debt. For Noruega, it initially demonstrates a strong financial stability with high solvency ratios and excellent interest coverage, as they have nearly no long-term debt, indicating low financial risk. However, its profitability metrics, such as net margins or ROE, are consistently low, reflecting limited returns for shareholders.
And the last one is Heineken, and as seen on the patrimonial analysis, they have problems facing their short-term debts, for example, low values on current ratio and exit test. They are also starting to make profit, and we suggest that refinancing its debt and evaluate option to reduce its net debt is the correct path for the firm.
We analyzed and we made a final consideration that, considering to our margins and our ratios, the best company is Mahou, followed by Damm, Noruega, and Heineken, because we consider that maybe the 2020 COVID pandemic struck most strongly with Heineken, and for example, Mahou succeeding in recovering very much faster. So this is our ranking, and thank you very much for your attention.